The bank approved the loan. The deal closed. 6 months later, one service manager quit, revenue softened, and the business was generating just enough cash to make the loan payment and almost nothing else. The approval was never the problem. The math after the approval is a completely different question. Most first-time buyers fixate on the down payment percentage and stop there. Standard SBA equity injection for business acquisition is about 10%. So on a $1.2 million deal, that's $120,000. Sounds like the number to hit, but it is not. The SBA guarantees roughly 75% of that loan. The bank still carries real exposure. Closing costs, lender fees, and working capital reserves stack on top of your down payment, and none of that shows up in the purchase price. The buyer who shows up at closing with exactly 10% saved is almost certainly undercapitalized. Budget well past the down payment before you start looking at listings. The down payment gets you in the room. It does not get you through the first year. An SBA 7A acquisition loan maxes out at a 10-year term for most deals. Not 20 years, not 30, but 10. On a $1.08 million loan at current rates, the annual debt service lands somewhere between $125,000 and $140,000. Lenders look at whether the business generates enough cash flow to cover that payment, which is called the debt service coverage ratio. It's not a hard covenant on an SBA loan the way it is on a conventional bank loan, so lenders have some real flexibility here. But flexibility on paper doesn't change what happens in your bank account. A normal year might leave you with roughly $220,000 after debt service. A soft year can drop that cushion to around $145,000. The payment doesn't move, your margin does. If you own 20% or more of the business, you are personally guaranteeing that SBA loan. That is a program requirement, not a lender preference, not something you can negotiate out of. If the business cannot repay, the lender comes after you, your personal assets, and if business collateral falls short, lenders will typically require you to pledge more, which can include your home. This isn't a worst-case scenario built to scare a first-time buyer. It's a standard program structure, and every SBA borrower needs to understand it before signing. Before you sign anything, run this test. Take the business earnings you've estimated in a soft year, subtract the annual debt service, and ask honestly whether you can live on what is left, because that is the actual deal you are making. The approval gets you into the deal. The payment, the personal guarantee, and the cash flow left after the bank gets paid, that is what you actually signed up for. Experienced buyers use the loan structure as a filter, not just a financing step. They ask what the business looks like after the bank gets paid, in a normal year and in a soft year. Run the debt service math. Run a 20% revenue haircut. If the business still works, then it's probably worth pursuing. If it doesn't, the price needs to come down. I go deep on all of this in the full video. Link is in the description and pinned in the comments. Research the deal before you fund the deal.